So, hello guys, you're not here, but we are doing a revision for efficient market hypothesis, which is section B. So, I thought we'll do a little video tutorial for you guys. We are starting with 2015 question paper, and the question is question 8. So, it's worth 25 marks. So, hopefully, by the end of our revision, you can all get 25 marks. So this is how we are going to start. We are going to explain what is market efficiency, the uses of market efficiency, then look at the 3 types, because if you look at it, there's 12 marks there. So we are going to look at the 3 types of efficiency and then try and get examples, because if you look at question 8 part A, it asks you to explain all the terms. Then if you look at part C gives you various examples of so you can identify which of the forms of efficiency she has outlined in the example. So yesterday I went to see Christine, then I asked her that how would we answer this question, and she said that we would look at the first part, which is question 8A, and relate it to C. So we would say whether it violates the hypothesis which we have explained in 8A, or whether it is consistent with the hypothesis which we have explained. So let's start. What is market efficiency? Market efficiency is the relationship between information and share prices, and that's all you need to know, just for you to understand. Then the uses of market efficiency is for business and corporate finances, and also for implications for investment. So basically, if investors have to study the relationship between the information they're getting and the share price, they're able to know which company to invest in or what stocks to buy. So that's why market efficiency is important. And for the business as well, by them understanding the market efficiencies, they're able to sell and buy stocks so that it makes their shares increase and maximize shareholder wealth. So now we are moving to weak form efficiency. What is the weak form efficiency? This form of efficiency is the kind that reflects all past information in stock prices. So anything that is in the past, just remember that keyword. This form of efficiency reflects all past information in stock prices. So let's say maybe 2 weeks ago, you're looking at those stock prices. That is a weak form of efficiency. Then now we are going to go to some examples of weak form efficiency. So, and she titles it in the lecture slides as empirical evidence of weak form efficiency. So, which basically means evidence. What is the evidence that shows that it is of weak form? So, we start with the calendar effect. And this is something that comes popular. If you look at question 8C, there's an example there which we'll come back to. So, calendar effect, we have trading hours of the day. An example of that is share prices tend to be higher on a Friday than on the following Monday. So for example, if you see a question like that and she asks you to discuss it, you would know straight away that it is a form of weak form efficiency, because it is showing because it is showing what has happened on Friday with relation to Monday. So, and why, if she asks you why our share price is higher on a Friday than on the following Monday, the reason you can give is Friday is the last day of the week. So most predictions in the markets would already have happened. So therefore, all the share prices will go up because it's the last day of the week. And so companies will start to see positive returns in their investments. And on Mondays is the beginning of the week, so people are probably purchasing new shares and there's no predictions as of yet. So because of that, share prices will be higher on a Friday where the positive returns are already there than on a Monday when there's no return yet because they are new investments. You get it? Okay. So now we move to the second one, which is January effect. And it also comes in the exam. So she can say that, stock prices in the US seem to be higher in January than any other month. So as soon as you see that January effect, it comes and clicks into your head that it is weak form efficiency. And in my research, the reason for that is because of year-end tax selling. And that means that investors sell their losing stocks at the end of the year to capture tax write-offs. And that means towards the end of the year, all the investors the companies start to evaluate their stocks which are doing well and the stocks which are not doing so well. And they decide to sell off the stocks which are doing badly. And the reason why they would sell it in December, and most of the transactions take place at the end of the year because they would need to release their end of year financial statements. And they want it to reflect to their clients that they have high performing stocks. So the reason why stock prices are higher in January is because the companies sell off all their shares in December. Then they keep all their higher selling stocks to begin the year so that it shows good performance for their clients. So that's the explanation for that. And the last example is called the momentum effect. And for that one, it basically states that the good or bad performance of a company will continue. And the reason for that I found is the past earnings growth does not predict the future growth. So that means if a stock was doing really well last week, it doesn't mean that this week it will go badly because you can't predict. It is random. So, and that takes us into random walk theory. Now, random walk theory states that market and security prices are random and not influenced by past events. So you can't say because Apple was doing really well 2 years ago means that in the next 2 years they're going to do really well, because it's unpredictable. The market changes all the time. So that is what the random walk theory is. And she normally asks questions on this. And I have an example here. So this is the question. And this I found from the seminar, Spring Seminar 2. And it says, the random walk theory implies that events are random, but if many events are not random,